this video, we're going to answer the question, does stock picking or active investing work? This is the second video in the Muslim Investing 101 series. So we've covered the time frame that we're talking about when we're referring to investing. The second thing that we need to cover is choosing a box. In most instances, we know which box to select, and that would be box C, the market. In most time periods, there is an easy solution to the problem of where should I save this money for the long term? In other words, where should I invest for the long term? Based off of research of all the strategies in investing, buying a portion of the entire market over time with the lowest fees possible beats other strategies. Now I keep on using this term, the market, this idea of buying the market. The market is shorthand for all of the companies that sell ownership to the public. When you combine all of those companies together, we would call that the market. So when you buy a company or a portion of a company, you are getting access to the future profits of that company as well as the future growth of that company. If a company becomes more profitable, then people will be willing to pay more to buy a portion of ownership. But there's another side to this coin, which is that companies like to sell off ownership of their companies so that they can grow while sharing risk. The other option for them would be to seek loans and pay back interest, but we're not going to be covering that in this course because that is not Islamically compliant to begin with, and it's a conversation for another time. So for the most part, Muslims are interested in participating in the market by buying ownership in companies. And the way that you buy ownership of a company is by buying something called the company's stock. You will often hear these terms used interchangeably, stock or equity. And whenever you hear that, what that simply means is a portion of ownership in a company. And that also means, by nature of being an owner, that you also share in the risk of owning that company because in the future, it may not be as profitable as it is today. The stock market is simply all of the companies willing to sell a portion of ownership to us, to me and to you. The question, though, for us is if we're going to be saving our money in the market, if we're going to be putting money that we hope to see down the line in the future, 5 or more years into the future, what is the best way for us to invest in this market? In other words, how do we pick which companies to buy? Because there are so many that are listed. We sometimes hear about companies from family, from friends, on the news, on the internet. How do we pick which company to buy? And this is often the way that we think about this. There's a company maybe for sale for $1. We hope that this company, because it looks promising, maybe we've read about it or heard about it, or maybe even studied it a little bit, we hope that it grows. And when we get the money back on the other side of the timeline, the $1 that we put in will return to us as $7. But what if rather than growing, it shrinks? So rather than our $1 becoming $7 or something like that, what if it shrinks to 50 cents? Or it disappears entirely? What then? How often does that happen? How often does a company that we hope will grow shrink or disappear entirely? How often? The truth is that of the thousands of companies that are listed on the stock market today, the vast majority of them down the line will either shrink or disappear. And so how do we pick stocks in an environment like that? Also, there's a strange anomaly that happens with all of these individuals either shrinking or disappearing. The market as a whole has grown. And so on the one hand, if you pick any company on the stock market today and fast forward the tape 20 years down the line, there is a very good chance that that company will either have shrunk or disappeared entirely from the market. At the same time, if you take a look at the market today and fast forward the tape 20 years down the line, there is a very good chance that the market as a whole will have grown. And that is what we have seen historically. In fact, the market has grown a lot. That's the growth of the 500 biggest companies listed in the US stock market. And that's the growth of $1 over time from 1925 to 2020. $1 would have grown from 1 all the way to $10,000 by 2020. That's been the growth of the overall market over that time period. So there's been remarkable growth in the stock market over time overall. But of all the companies in the stock market since 1926, the returns of the market can be explained by only about 1.5% of the entire market. That's pretty staggering. So of all the companies over the entire history of the stock market, the returns, when you factor in inflation, can be accounted for by 1.5% of the entire market. And so we're talking about needles in haystacks. The stock market today is of a certain size, and there's a very good chance that the stock market down the line several years from now, a decade from now, will be larger than it is today. But when we look back, the reason for its growth will not be because every single company grew an even amount. It will be because a very, very, very small group of companies grew a lot, and the majority of companies shrunk or disappeared entirely. And some people think that they can consistently find these needles in the haystack. We call these people active investors. Active investors, either as professionals or as amateurs, are people who think that they can find the needle in the haystack. And if you're an amateur, you might talk to friends, you might have groups that you are part of, you might do some research, you might read the news. And if you're a professional, you probably work for a wealth management firm like the ones shown here. And again, active investors are people who are looking for needles in the haystack. And they often miss, because when you're looking for needles in the haystack, there's a good chance that you're not going to find any. Some people don't look for the needles in the haystack. Instead, rather than doing that, they buy or take the entire haystack. We call these people passive investors. And for the purposes of this course, we'll note two ways that people can be passive investors. Either they can use a robo-advisor, or they can do it themselves. The do-it-yourselves method would be to sign up for a brokerage and to use some method to balance a portfolio. Or with the robo-advisor approach, you would simply sign up for one of these companies, like in Canada, two major companies that provide halal robo-advising services are Wealthsimple and Manzil. You would sign up and begin an automated investment through them. This video is part of the Muslim Investing 101 series. Be sure to check out the entire playlist. And if you find the videos on this channel beneficial, please like, subscribe, and share.